Welcome back to Startup Accounting 101. This is a video series for founders to understand accounting fundamentals for running a business. We're moving through the financial projections template, which is available for free from score.org. Go to the template gallery and download this file. I'll have their link in the description below. So this video covers tab 4. Here, which are additional inputs. This tab is basically where you'll be able to set up like company specific assumptions. And I'll go through each section and describe what they mean and what and how you want to set it up. So first we're going to start with this section, which is accounts receivable, AR, day sales outstanding. This section basically estimates how long it will take for you to collect payment from your customers. Now, there's comments for all of the different sections, so I'll just go through them. So paid within 30 days. Here it says, if you are a retail business or don't have accounts receivable, put 100% for each year. And by default, everything's at 100% already. And this is applicable to you if you have a business and it's all cash or credit card. So this would be applied to you if you're like a restaurant or if you have an e-commerce site like Etsy, Shopify, or you're a small business and people pay you at the register and pay you with a credit card. So that would be you, and you would have 100% across the board. Now, paid between 30 and 60 days. In this field, put the percentage of sales that you expect to carry as AR or accounts receivable. If your business sells in cash, as mentioned before, put 0%. Otherwise, estimate the percentage that will be paid between 30 and 60 days after sale. Now, if you are a CPG that works with wholesalers or Costco, you likely will have what's called net terms with the customers. And so when you make the sale, this is how long you have given your customers to pay you those invoices to remit payment. And net 30 is the most common net terms that you'll have as a business. So that's in this section. So what's the percentage of sales that you will have based on the sales forecast? There's actually a breakdown here. So the total category here would be, this would be MSRP or, selling on the website, which would be 100% cash. And then your wholesale and your Costco sales breakdown, it's about, 40% plus another, 32%. So that's actually like 70% of your sales. So this instance, I would actually put 70 for me. And I would assume that it's about the same across the board. I could just come over here and take a look. Yeah, it's about 70 for year 2. Year 3, it's about also 70. So pretty close to 70 across the board for me and the estimates I've made. It's about 70 for 30 to 60 days. Now, moving to the next section, paid in more than 60 days. In this field, put the percentage of your sales that you expect to carry as AR, but not paid for more than 60 days. If your business sells in cash, put 0%. Otherwise, estimate the percentage that will be paid more than 60 days after sale. So this is really, if you have an estimate, if you have any historical data to show like net 60 term customers, you would put it here. For me, in this template, I'm going to say I don't have any. So for me, it's 0%. Now, the last section here is allowance for bad debt. Okay, allowance for bad debt is the percentage of total AR you believe will not be collectible for whatever reason. It could be because your customer becomes insolvent, goes out of business. If you can find an industry average for your industry, use that percentage. If in doubt, use 0 or 1%. Many businesses that have good collection processes may have substantially less than 1% during a strong economy. Bankers like to see a figure here because it lets them know you are realistic about discounting the total value of AR, accounts receivable, as collateral for a potential loan. So here is the estimate of how much of your AR will essentially default and will not be collectible. So typically you'll run as a business, an AR reserve or bad debt analysis will be made to determine what percentage this should be. And usually you will analyze like a rolling 12-month of your financials, and you will determine sort of the bad debt to AR ratio. Now, if you don't have that, you can go ahead and leave that at 0%, especially if you don't really know if you're just starting out. I would leave it at 0%. I do have a note to the side here. So for many of these retailers, 2%, 10, like net 30 is a really popular net terms that you'll have with customers. And that 2% is like a prepayment fee. If your customers will pay before 10 days, they get a 2% discount. So for this template and for forecasting purposes, that 2% discount, which I know many, if not all, of the wholesale customers will be taking that deduction, I will go ahead and put 2% there. It's not truly bad debt, but it will sort of dilute your AR collection and it will affect cash flow. So for that reason, I'm just going to park it there. And here is, this should equal 100%, which makes sense. So this is 28. So that is the AR breakdown for me. So I would go back to your forecast to see what you have here. If you broke it down by different product lines like this, you'll be able to see the breakdown of your sales that may have net terms that will affect this collection percentage and also affect your cash flow. So now we'll move to the next section, which is AP, or accounts payable. Ideally, we'll be paying all of our bills on time. Most vendors have net 30 terms, but I would leave this at 100% paid within 30 days. This is, the assumption that you'll have as a business is that you'll pay all your vendors on time. And this is the most conservative estimate anyways, so I would leave it at 100 and move on to the next section, which is line of credit assumptions. And here we have a note that says, how long do you want to let your ending cash balance to get? Like how low, do you want this to be? The minimum should be $0. the absolute minimum, but you might want to choose 1,000, 5,000, etc., some other number. The minimum cash balance is really up to you to decide like what's most comfortable. So I chose 30,000, and I did that based on the payroll numbers. So if I look at year one, my monthly, salary and related expenses, like payroll expenses on a monthly basis, is about $30,000. And for me, it would give me peace of mind to know that at least I will have enough cash to cover payroll, and my people would be taken care of at the very least. That's how I would want to project it out. So my minimum cash balance I'd like to have in my checking account is $30,000. The line of credit interest rate, I think is about 8% right now. But, if you have a relationship with a banker, you kind of know what, business credit you'll have, you can adjust this. And then we're moving into the next section, which is fixed assets. Any additional additions that you'll make. So here in the beginning, we have depreciation in years. I would leave this. This is pretty standard for depreciation. In January, this actually comes from what was originally set up in starting point. So starting point, this was the estimate of how much equipment you need to get started with the business. And so this is just pushing out into here. In this section, you'll see or decide if you need to buy more equipment throughout the year, and then also the second and third years. Let's see. What does it say? It says, use this space to add items purchased after the date of the starting point, tab 1A. So I know that there's like a spike in sales and production for October. So I can estimate, okay, in October I might need to buy more equipment just to handle the increased output. So I'll just add 2,000. And then every year I'm gonna at least purchase more equipment. It could be a replacement, it could be an addition. And then the third year, I think I'm doubling again. So I'll just say I'm going to buy even more equipment in year 3. So if we go down into the next section, we have income tax assumptions. So this is the effective income tax rate for your business, year 1, 2, and 3. The tax rate really depends on your corporate structure. So I have a couple of notes here. If the business is a C Corp, there is a 21% tax rate. So I've just put 21% in there for now. I'll just assume that this is a C Corp that I'm projecting out right now, because the other corporate types, S Corp, LLC, those are generally called pass-through entities, and at a corporate level, the tax rate is 0%, because all of the income will flow through the owners, whoever's the equity holders, and they will report that on their personal income taxes. So as a company, the tax rate is 0. And now we have the last section, which is the amortization of startup cost. Now I have a couple of notes here. You are allowed to deduct up to $5,000 of startup costs in the first year, and then you can amortize the rest of the balance over 15 years. So this template basically covers 3 years. So the default in here is 3, which I'm comfortable with because this projection covers 3 years. So I'm fine with that. So for both of these sections, both income tax and amortization of startup costs, please consult a corporate tax accountant to make sure that you have the right rates that's applicable for your business. And that's it. Okay, so we've completed the additional inputs tab. The next video we'll be looking at operating expenses. Like and comment if you found this video useful. Let me know if you have any questions. Please subscribe, follow along, and thank you for watching this video.